We're going to talk about the stock market. We're going to go over what we saw yesterday, what I think is going to unfold. But the big question on my mind this morning, the question I keep getting the most from ARMR insiders is starting to disturb me. And so I want to address it on this call. Okay. We're going to talk about the ARMR investing way. We're going to talk about how I run my own personal capital. So we're going to get real personal here. I'm telling you, when I'm doing my money, I do that every day. I try to avoid making predictions about the market. And I say that I avoid it because the market makes fools out of most of us most of the time. Because the basic premise of the ARMR report is to read and react to what we're getting and to just execute. And if you make too many predictions, it makes it hard to execute because you're like, this can't be right. I thought the market was going to do that. Okay, so I generally avoid it. But I'm getting so many questions. Every time the market goes down, I get the same questions about buying the dip. And it's starting to disturb me. So I feel like we need to have a conversation about it and go over what's happening in 2022. Okay, totally different than what was happening in 2020. And we're going to go over the two things. So don't let me stop you from doing whatever it is you want to do. We all trade differently. If the questions are about buying a dip and trading it out the next day, I would never begin to tell you what I think the market will do from day to day. I don't know. Sure, buy a dip, sell it the next day. But when it comes to investing, managing capital, being a steward of your own capital, the reason that the ARMR report was created is for the big picture investing of capital. So it's not really, the ARMR report's never been created about, can I buy this unbelievable collapse in a stock and maybe sell it the next day because it bounces? Yeah, you could, right? But that's not what the ARMR report's about. The ARMR report is about protecting capital first, capturing upside second. And the way we do this is we take a top-down approach. We look at the big picture, big indexes. That's what the risk monitor is. Then we look at sectors and groups. And then we look at individual stocks on our whiteboard and we build portfolios. Okay? So do your own due diligence, make your own decisions based on your risk tolerance and all those things. Okay? Now we're going to get to the meat of this conversation. There is no way that I'm buying any dip in the market. No way. Buy the fucking dip is something that works when the Fed is buying the dip with you. It worked all through 2020, all through 2021, because the Fed was adding liquidity. Don't confuse an ability to make money in a bull market with intelligence. Understand that you're making money buying the dip because the Fed is buying the dip. So you're on the right side of the Fed, so you're making money. You cannot apply that approach to a market with runaway inflation, a Fed behind the curve, a Fed reducing liquidity, a Fed raising rates, a Fed selling every rip. I hope I'm not coming across too aggressive here, but it's disturbing me that the thought is still, can we buy the dip? Let's go look at a couple things and see, should we be buying the dip? Okay, let's start with this. This is a major head and shoulders top breakdown. Who wants to buy that dip? It's a big head and shoulders top breakdown. Here, the Fed is buying every dip adding liquidity to the system. Now the Fed talks about we're going to stop buying the dip, so the market makes a top. And now the Fed is selling every rip. And this is why the market's breaking down. Now, again, can the market rally for a week? Absolutely. Okay, so I'm not talking about that. So if your questions are about, can we buy a dip for a bounce of a couple of days? Okay, I mean, I'm not doing that, but if you want to do it, go for it. But it reminds me of this wonderful image. You look at that right there. That's the steamroller that's coming your way. And you want to bend down and pick up quarters in front of the steamroller by buying the dip. Now, it used to be you'd bend down, pick up pennies in front of the steamroller, but this is inflation. Okay? What you're doing is bending down and picking up quarters in front of a steamroller by buying the dip and trying to trade it. Will you get lucky? Will you grab a couple quarters? Sure, maybe. But you also might be distracted and get run over. And I don't want to see that happen to you. The ARMR Report's core value is protecting capital first, capturing upside second. Okay? It doesn't get more clear than that steamroller. Here's another steamroller. This is the NASDAQ 100. So what we like to do here is we say, hey, we're going to look at the big picture first. So let's look at it together. The risk monitor's red. It's a negative gamma environment, and it's rolling lower. That negative gamma is pressing the market down. Now, there can always be gamma rips for a day or two because you get oversold conditions. I'm not talking about that. I'm talking about big picture now. Do I want to put my hard-earned dollars? Do I want to put, I'm a steward of my own capital, family capital. Do I want to invest it in a market like this? And the answer is no. Okay? The answer is no. Negative gamma, risk monitor red, Fed removing liquidity, inflation out of control so that the Fed can't save the market. How would the Fed do an about face and start buying assets again? How could they do that? I mean, I guess they could do anything. And if they make that decision, I'll change as well. But I think the market's a lot lower before they do that. Okay? So I don't make predictions, but now I'm making a prediction. I think the market's a lot lower before the Fed starts adding liquidity again. Here's something that really bothered me last week. The last leg that the market was standing on is commodities. The commodity leg was carrying the market. Look where XOP is an example. We'll look at some ETFs. So this is how we go from top down, which is the risk monitor, the top big indexes. Now we start looking at groups and sectors. Okay, so you're out of the top of the channel on the XOP, which is the E&P companies in the energy space, with a major breakdown. That is not even close to an entry point. Can it make a bottom on the 50? It might. And I'd be happy to put some money to work. But I wouldn't be buying it right here. How about XLU? Money's been hiding in utility stocks. I submit to you, how do you hide money in utility stocks when the yields on many of these utilities is now equal to the 2-year Treasury? That doesn't fly. Utilities usually yield more than the 2-year Treasury note. For those of you new to, that kind of interest rate structure, government bonds are considered the safest, so they carry an interest rate, and then every other bond that's corporate, not as safe, right? So the yield has to be higher. That's usually the structure. These stocks, the utility stocks, have skyrocketed because people are afraid of the market and they're hiding. At some point, rates on government bonds go so high that people say, okay, I'll hide in government bonds. And they sell the utilities. So utilities were down last week. Every sector is getting taken out to the woodshed all at once. We haven't even talked about gold and silver, right? But there's a breakdown in GLD. The list goes on and on. At the end of the day, the last leg that the market was standing on that we were making money with are commodity stocks. And they got wrecked last week. That's not the kind of thing that just reverses and starts going up again. It'll take time to build a base. Now we move on to a conversation about, there's a particular guy, Jim Bianco. I follow him on Twitter. I think he's pretty smart. He shared this chart of what's going on in the 2-year Treasury note. I'm going to share 2 charts with you. One from Spot Gamma yesterday and one about the 2-year Treasury note today. There is something very disturbing going on in the bond market. Stocks follow bonds. Major head and shoulders breakdown in equities. And there's something very disturbing going on in the bond market. As Bianco tells us, the carnage in the bond market in 2022 is something we haven't seen before. This has not happened before. Nothing remotely close to this has happened before. Total return, Bloomberg aggregate index, 68 trillion in assets. It's lost 10% year to date. Never happened before. 2021 was the worst year for the 2-year Treasury note. And this year's worse. This is a picture of that. So what I'm showing you right here, Bianco put this out. Okay? This is the 2-year Treasury note. Look, it's never happened before. Absolute destruction in 2022. And he makes a great point, and this is what's key. Who buys the Treasury note? Someone with a lot of leverage doing a carry trade. Hedge funds and banks. The system's not designed for this type of collapse. So let's scroll down to our chart from yesterday. The bond market knows there's something seriously wrong because the bond equivalent of VIX has gone ballistic. And you're seriously asking me if we should be buying the dip? Do you see my concern here? I mean, I don't come out and have conversations like this with you because I don't want to get in your way. I want you to do whatever you think is comfortable for your portfolio. And I could be wrong. I could be wrong. The whole market could go up tomorrow and start to skyrocket, and we'll find out later why. Okay? I could be wrong. But my job, as I see it for myself and what I share with you, is to get us on the right side of probabilities when reward is worth the risk. And if you look at what I just talked about, there's no way buying the dip right now puts us on the right side of probabilities. There's no way the equation of reward to risk is optimal right now. There's no way. My case rests. Moving on. What do I do now? What do I do when I'm tons of cash, not buying the dip? Now's the time for me to really focus on research, shore up my whiteboard. When the market starts really going down, the cream rises to the top. I start building a list of relative strength leaders that are still in bases or making bases so that I'm ready to roll when the risk monitor changes. Okay? So that's partially what I'm going to be doing. And I'm going to share that information, with you as I go. So on the live trading desk, the live trading desk is not just about day trading. We do day trading there, but we really spend a lot of time doing research, sharing information amongst us, listening to conference calls, getting ourselves ready for when it's time to put money to work. And then when that time comes on the live desk, we talk about how to structure portfolios. So I'm going to give you an example right now of how to use the ARMR report to structure a portfolio. This is what I do personally. And so this is just a thought. I can't tell you how to build a portfolio. I don't know your personality. I don't know the assets you're running. It would be wrong for me to tell you how to do it. So I'm just going to share with you what I'm thinking from my capital as a starting point for you, and then you could take it from there. We have 4 portfolios that we share with ARMR insiders. Index only, ETF swing, growth, dividend. Those are the 4 portfolios. Our job is to understand the market we're in and then use those 4 portfolios to structure a balanced approach. So as an example, what I mean is if the Fed starts adding liquidity at the bottom of a market crash in 2020, I want to overweight my portfolio into ARMR growth, into ARMR dividend. I want to build those things out. Individual stocks. I want to take more risk. That's the time. But this is what I'm going to be doing the next time the risk monitor goes green. This is what I'm going to be doing. I am going to put 1/3 of my capital and capital that I manage for others into ARMR index only, which means when we get risk monitor green, we're going to own all 7 indexes. We already know what the stops are. We know what the targets are. So when it pops up, we start booking profits. We are literally going to be following the algos. For 1/3 of our capital, we're going to be swing trading the indexes, following the algorithms. Goes risk monitor green, the money gets put to work, 1/3 of our portfolio. As it goes up, we take profits, raise stops. This is a conservative way to put money to work because it's liquidity of the indexes, right? It's algorithmic based. I mean, it's a simple way to get exposure at a time that's going to be difficult to get exposure because I'm not going to want to put money to work. Risk monitor is going to go green. I have to execute anyway. Okay. So when I see the risk monitor go green, I put money to work. What I won't do is buy a whole bunch of individual stocks. First thing I'll do is buy the index. Second thing I'll do is I'll start looking at group ETFs. Again, I want to minimize individual stock risk in the bear market of 2020. There's going to be bear market rallies throughout the year, and we'll be able to see net worth go up if we trade them correctly. I'm going to focus 2/3 of my capital on index ETFs and group ETFs. Okay. And then with the last 1/3 of my capital, I'm going to focus on growth stocks. Now, the dividend portfolio is a totally different strategy. And so I'm putting that capital aside right now, not talking about that. When I manage capital for investors, they have other portfolios. They might be building a dividend portfolio on their own. So that's not really why they're working with me. Some they are. I have very conservative portfolios. All they want is dividends. And the whole thing is, dividend portfolios. So that's separate over here. That's a real personal thing of what are you trying to do with your assets? And personally, I have a portfolio for dividends. Okay. So that's why I share with you what I'm doing in that portfolio. But for the sake of this conversation, I'm going to have 1/3 of my capital in each of those endeavors the next time the risk monitor goes green. It doesn't mean I put 100% of the money to work the minute it goes green. When the risk monitor goes green, 1/3 of the portfolio goes into indexes. That happens immediately. Then the other 2/3 of the portfolio gets invested based on where the opportunities are, when we get algorithmic entry points on groups or stocks. We may never get to 100% invested because we might not get enough entry points. The whole market rolls over, breaks down. We carried cash. Maybe we only have 50% invested. I don't know.